However, what we are seeing now is we've had a little backing off of the oil. You've got the tech stocks rallying. You've had a little bit of a pullback on the rates on the bonds. You had a bit of a Bitcoin mini bounce, and you've got a much more energetic bounce on gold and silver that has come in, and you're getting a rally. I want to warn a little bit, and we'll go to the charts when we do that, but I think there's a third sell-off on the precious metals still to come. So even though you're rallying now, and it's super tempting to be, as a trader, to be buying that rally on gold, I can't answer how big a scale type slap down, and typically you get selling in waves of 3.
Precious metals desks around the world pulled in $3.9 billion in 2025, making it the most profitable year on record for gold traders, according to data tracked by Coalition Greenwich and reported by Bloomberg Markets. That figure did not come from a quiet, steady rally. It came from chaos. The bank highlights gold's role as a portfolio diversifier, especially as cross-asset correlations rise, and expects safe haven demand and central bank buying to underpin prices over the medium to long term. The market sniper FrancisHunt mentions that as oil and the dollar begin to ease, markets are seeing a temporary rebound in risk assets and precious metals. However, he warns that this bounce may not be sustainable, as markets often move in waves. Looking ahead, gold and silver could face another sell-off before forming a more stable base, suggesting that the current rally may be short-lived before the next major move develops. Regarding the recent bounce, FrancisHunt says a sharp drop to $3,500 is unlikely unless a major crisis unfolds. From a technical perspective, Francis notes recent volatility in gold and silver reflects normal consolidation within a larger bullish trend. He explains that despite sharp corrections, both metals are forming continuation patterns, suggesting the broader upward cycle remains intact. He mentions that silver is still well above earlier breakout levels, reinforcing the strength of the long-term move. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from FrancisHunt's recent interview.
Essentially, we've got a bilateral market, almost binary. You've got spells that we've had now of dollar strength that's just kind of had a little bit of an ending. During the dollar strength period, here's how the theme goes. It's usually associated with oil strength even more than the dollar, so it's an oil squeeze up, which is part of a stagflationary move, which is going to lead to a hyper-stagflation, is what we've predicted as our major macroeconomic environment. More on that in a bit. But in terms of market trading, if you're long oil, you're also partially long a dollar, even though that's counterintuitive because oil is obviously priced in the dollar. And in our view, we long the dollar during that period, which has just kind of had an ending, a little slap in the face. During that period, you want to be long the dollar against the Korean won. You might even have a little bit of long the dollar against the yen. This is a dollar assertive period. It's been a softer period for gold and silver. That's obviously changed just recently. We'll talk about that. But more generally, the last 2-3 weeks that are behind us, it's been a bearish period for tech and tech stocks. It's a sell-off period for Bitcoin, and it's been a soft period for gold and silver. During that, which is the stagflationary element. Why? Because debt and fiat dies. Rates have been going up on the bonds down as well. So the things that go up are the dollar and the oil during the Hormuz narrative. And all the other things I mentioned are largely short. However, what we are seeing now is we've had a little backing off of the oil. You've got the tech stocks rallying. You've had a little bit of a pullback on the rates on the bonds. You had a bit of a Bitcoin mini bounce, and you've got a much more energetic bounce on gold and silver that has come in, and you're getting a rally. I want to warn a little bit, and we'll go to the charts when we do that, but I think there's a third sell-off on the precious metals still to come. So even though you're rallying now, and it's super tempting to be, as a trader, to be buying that rally on gold, I can't answer how big a scale type slap down, and typically you get selling in waves of 3. I do just want to say, with this kind of bounce on gold and gold leads, I really think the 3.5 grand callers are going to be caught short. I don't think you're going to be seeing that. But Who knows? It will take a different degree of crisis. That means they're prepared to let everything go, all fall down. If you get the 3.5 grand to the downside run, which can happen, it's just not my highest probability option. If we get that, the Nasdaq and Bitcoin will be horrendously down in that, and you'll be in, okay, this is the correction. And there is the possibility that we're going to have that moment. I just think they're going to drag this out in stages, and I don't just think you're going to get the whole puke, right now, every last chunk, and you go projectile vomit the lot in the next session. But so I think we're going to continually to have bad, worse, bad, worse. There's going to be hot, cold, hot, cold. You're going to be kept tap dancing because generally traders lose in those markets because they're chasing momentum and responding to news. And the minute you start responding to one form of news, by the next week, they're pivoting it on you. So you end up always, buying tops and selling bottoms, and you want to avoid being caught in the reactional cycle. So I tend not to listen to the news, just look at the charts and say, I think you're going to get sold off one more time, gold. I stand ready to utilize that opportunity, and I'll wait till you show me the bottoms in. I'm not trying to buy the bottom. I'll let the first 5 or 10% put real volume in. That's the value also, and I'm using two different kinds of candles here, but the fat candles show you real volume as well. And right now, these two candles are not, in terms of 12-hour sessions, not particularly fat, and they can be retaken back. You'll note when you get to lows, you tend to get the bigger volume, real capitulation selling here, and then real value buying there. And even this candle and the one in between, that was real. Okay, guys, if you're coming down here, we're buying. Those three guys had quite a bit of fatness on them. These are quite skinny belinky, as I would say. It was very much like the in-betweener waiting for the news. Very small, low vol, you get the spiller. So I'll watch and see. Those can be taken back relatively easy, given the volume that they're going up on. Well, that's GLD, which is quite clearly mimicking. You can see there's a commonality with the gold, and you can see the tops. You could see that we were getting fatter on the green here, and then you had a super fat red with quite a volatile session. That was a bit of a warning because you gapped open. This is on a 12-hour even, so it's not even a daily chart. And you came right the way down, rallied right the way back up. Very volatile. If I put the volatility index on that, you would have seen that was getting pretty high. Interestingly, it might have a little bit flag-like type structure in terms of it. All of these structures, both on gold and on silver, are what we call continuation of macro trend structures, despite the fact that they sold off a great deal. Remember, we called the start of a generational move at 25.9, and silver's still at 77. It's still at nearly three times where we called the start of a generational move, despite having a 45% correction in that. All ongoing. We've got a $333 target where you'll gestate again. Then we've got a single digit gold silver ratio, which you'll see it be quite a bit higher still as well. So this is in the same category, Andy, of what we were talking about. This is just continuation trends with cycles in between. And you've had the one sell-off, you've had the second sell-off. The one sell-off here was really violent, big volume, and you can already see the volume reduce quite a lot. Yeah, you are a little bit uppity on quite thin volume, which sets you up for if you get a bit more uppity for that third sell-off. But that doesn't mean you go all the way to the bottom of the channel range. I think you could do something like that. And the break that you want is that capping, descent, grind line, which is the top line structure in a flag-based continuation situation. So this is still a flag. You look at where you come from. That's a big flag pole, That's a flag on a flag pole. So there's no crying in baseball. This guy goes higher in due. If your time frame is long enough, this guy goes a lot higher.
Yeah, that's excellent.
And don't forget, they had a perfect storm, which they weren't really fully given the gift of before that we had, and we'd called this that oil was underperforming gold for an extended period. So you had very cheap energy for mining and you had very high mining prices. You've had a short-term inversion of that, which has affected margins somewhat with the increase in the energy costs and a decrease on the top line number for revenue. So there is a little bit of a multiplier effect on that, and you saw that. So you're in on the gold silver ratio. Something else worth watching. You had a very big move. We actually, funny enough, drew this on a smaller time frame. You had a little squeeze there that was pointing to the gold silver ratio going up, which was pretty bearish. Generally, you normally don't want that in the bull market. It was that little guy over there. You got overperformance, you got a flag again, and you got a further surge upside. This was at the worst moments, and silver got the hardest sell-off first time. Remember that. And what I've been highlighting is now, if I change color, you're kind of in a different space. You're in a flattening, reducing volatility. I probably want to do this. You might have 3 there. Now that could break easily to the downside, but you can see the volatility is reducing, and we'll see. But maybe first it goes a tiny bit higher on the range before coming down and breaking. It depends how gold and silver react on this current rally and possible rollover. I'm assuming in my base case that there would be one, but it's not a guarantee, or it's already happened and was much smaller, hence the disproportionality I mentioned.
A trending topic on the social media platform X on Tuesday was the recent growth of extreme out-of-the-money calls in the silver market, with some noting December options with a strike price of $1,000. Some financial market influencers have equated the enormous spread to smart money, betting on much higher prices by year-end. However, some commodity analysts warn that these call options are bordering on ridiculous and are garbage trades. Regarding silver, FrancisHunt says its setup currently appears even stronger than gold's because it experienced a harsher initial sell-off. He explains that while gold led the early stages, silver's deeper correction, nearly 45% from peak to trough, gave it more resilience on the rebound, creating a more robust structural pattern. Despite minor volatility spikes and zigzag movements, the overall trend shows compression and stabilization. He suggests a lower volatility environment in the near term. Francis emphasizes that this low volatility phase should not be mistaken for market stagnation. He predicts that after this consolidation, silver is poised for a strong upward movement, though sudden momentum bursts could create sharp, short-term spikes. Let's get back to the interview.
The exciting thing for silver is this is almost a better setup than the gold one. Gold will lead, but this one is pointing to a disproportionate reaction given how hard it sold off here. It almost had its worst sell to start. And I want to just highlight there is a difference here between silver and gold. Silver got properly spanked on that first instance. You were nigh on a 50% correction. You were at 121.67 and then you're down at 63 at the low. Now, if you double that, that takes you to 126. You're nigh on 50%. You're probably knocking on a 45% correction. Gold being more robust held up better in the first instance, but had a far nastier sell-off period here. Once it was quite clear we were selling off for a second, and it had an extended second sell. Silver has shown that actually it was more robust because it had taken a bigger beating first time. It didn't rally as high as gold. So remember, I highlighted that you did a 78.6. So silver was flatter on the down leg and the recoil rebounds. But since then, the compression from these levels has been far less. So actually on a relative strength basis, since this sell-off occurred again, silver's been stronger. And we prefer this overall structural pattern, which you might note. I'm just going to hide my point and figure tool that has been doing some draws there as well, and just show you the falling wedge. So this is a beautiful and classic technical setup. There was a squeeze, by the way, that was taking you up. And we talk about the 3 impulse falling wedge. And what you quite clearly have is the very steep one, which is typical, the high volatility, blow off into proper slap, Remember, silver got the harsher slap first time. So we often talk about Church's steeple in terms of the spikiness of the first impulse. Then you get more of a flattening. There's some complexity. It's more of a king's crown. It rounds out a bit of convexity. You can see some of the volatility is dissipating, but still relatively volatile, just not as violent as this. You see those two candles there were brutal candles. And we had a lot of bleeders on our YouTube channel, moaning at me that silver went down as if it's going to go up in straight lines because we sort of, the silver messiah and now we are the silver bastard. And you said, and we were like, well, we were fortunate to have got out before that. And we even mentioned it on X that we were expecting this to fall. We had a lot of targets here. Second interims were run on big macro setups on HVF method. So we had actually been stepping back. We didn't ride that downside, but a lot of the free views on YouTube did. And it was a case of you should have stop losses and you shouldn't trade off of any signals unless you have all the signals. So what's actually happening for us is that you're in a creation of a more low vol third move.
Excellent.
And this may or may not bounce here. It may come to the same level as the last low. It could come a tiny bit lower. But when that part is done, we anticipate a break. Now, there are some really high momentum moments where you can have a rushed third impulse. I don't think we've met the criteria for the third impulse, but we sometimes talk about, and this is how we'll be wrong. So for those that ask, you always got to ask, how do we be wrong? You could have a rushed third impulse. Sometimes you can do just that, and it just doesn't move to the splitter, and that's it. It's very disproportionate to everything else, and typically the best structures have quite a bit of proportion. So that would be a very rushed third impulse, and it didn't come down clearly to the lower basing descending grind line that I've highlighted here. So it's less likely, it lacks proportionality. What you'll also know is we get a concept we refer to as complexity, where you zig and zag, even though overall it's a arc, much like that. You can see that it shoots a little bit beyond to the upside, then a little to the downside, then a beyond to the upside. The crown element, the spikiness, that's called complexity, the degree that it varies to a nice smooth curve. And it's absolutely normal for you to have some of that in the three. So were you to have that, you do a little bit above, then you do a little bit below, a little bit above, a little bit below, a little bit above, a little bit below. But they tend to be a bit smaller. In other words, not as big as these swings.
That is drastic.
Yeah. So you continue to see dissipation in the volatility. It's like a calming incident. I mean, we refer to it as the slap in the face, technically, when you get this degree of volatility, because it's kind of like, somebody chatting up a girl and it's all going so well. And then he starts to get presumptuous and puts his hand on her knee or something like that. And then he gets a short, sharp slap in the face. He went too far too soon. And then it's kind of like a face saving, reducing the volatility. I'm sorry, respect your space. Can I do, anything? And it's all like, it's got to calm all down before he can either gracefully depart or hope to try rebuild his chances. And that's what you get in the market. You've got this jolt, and volatility dissipates slowly, but it can sometimes return with a bang out of nowhere. So it can detonate. So unlike tides that come in slowly and they go out slowly, volatility is something that explodes from a very extreme low moment and then takes its time like a tide dissipating. So we are probably going to watch it become a bit boring and a bit dull. And you want to celebrate that, because that's when everyone goes, it's a boring market, let's go elsewhere. That's usually just before it's about to start moving again. So
Great point. Great point.
Yeah, extreme low volatility.
The important takeaway for investors is that gold's structural case is still compelling, especially with a long-term time horizon. However, real asset demand has shifted and is linked to fiat currency worries. Looking ahead, the question is whether 2025's record can hold. If central bank buying slows, or if the Federal Reserve signals a more hawkish stance that strengthens the dollar, gold could face headwinds. For now, gold traders are operating in the most favorable environment they have ever seen, and the numbers reflect that reality. Given these dynamics, are you prepared to stay the course through temporary swings, or will you chase short-term rallies in a market where the next major move is still unfolding? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.